Greetings of the day and welcome to the session. So in the previous session we have finished 4 P's and 3 P's, total of 7 P's. So 4 P's are related to product, price, place and promotion, and for service sector again we require 3 P's, people, physical evidence and processes. Now let us move to the next question in marketing management strategies, that is different promotional methods. Different promotional methods that are used to promote your particular product into the market. That means this is related to a very important aspect of marketing, that is promotion, or generally many people call it as advertising. But here we treat advertising as a separate part. Okay, now let us understand about the promotional methods. And modern marketing is highly promotional oriented. You need to promote your products, you need to sell yourself into the market, you need to make proper communication to the customers about your product, about the features of your product. You have to persuade the customers to purchase your product, you have to convince your customers. That is very important. That means it is not just enough if you have quality in your product, but along with quality, promoting your product into the market in the right way, using the right channel is very important. And here we will have 4 different methods of promotion that are discussed here. The first one is the personal selling, second one is advertising, third one is publicity, and fourth one is sales promotion. Now let us focus on these things one after one. First one is personal selling. In personal selling, what we do, we appoint some salesmen so that these salesmen will go to the prospective customer, talk to them face to face in an oral communication, communicate about our product and make the customer to purchase our product. But this personal selling method is a very expensive method because you need to recruit many sales personnel where you have to pay them a lot of salaries and the outreach is very small. That means each and every salesperson can reach up to only a certain number of customers, but not many at a time. So for expensive products, for premium products like real estate, premium cars, premium watches, generally companies use this method of personal selling, employing the sales personnel and making them to meet the prospective customer. And the second one is advertising. Advertising implies mass marketing, where we take up advertising in TV, in newspapers, in radios. Okay, and today social marketing, social media marketing also comes under this advertising. So this is again a very costly affair. Advertising is also a very costly thing, but the outreach will be very high. You can reach large number of customers, large section of customers at a time using advertising methods. And the third one is publicity. In publicity, we focus on getting publicity for our product or service in a cheaper way compared to advertising. Here, we will make some press release or advertorial content, or we will try to publish our achievements so that people will read them, people will understand them. So that is publicity. And the fourth one is sales promotion. Here we give some cash discounts, we give some cashback offers, we give some points to the people so that our products are more appealing to the customers. So that is sales promotion. And with this introduction, let us start with the content given here and read one after one. First of all, promotion stands for activities that communicates the merits of the product and persuade the target customers to buy it. So promotion means communicating. The most important word here is communicating. Communicating does not mean just telling about your product, but communicating is persuading the customer to buy. Here another important word is persuade. It's not provocation, it is persuasion. Persuasion means convincing with a good logic, convincing the customer with a good logic to understand the importance of your product, to understand the features of your product and making the customer to make purchase of your product. So that is called as persuasion. Now why we have to do the promotion? Because we need to persuade the customer. We need to make the customer understand the importance of our product, the features of our product, and we need to make him buy our products. So for that, we do a lot of promotional activities. And you know, modern marketing is highly promotional oriented. That means you have to promote yourself. You have to promote your products. If you just make a quality product and put it in the shelves of the shop, people are not ready to purchase it. You have to communicate to the people about your product, about the uniqueness of your product, about your unique selling proposition. You need to tell them and you need to persuade them. Okay. And this promotion is a very important part of marketing, and it gives impetus. Impetus means push, stimulus. Okay. That means you have to push your products into the market, and that pushing your products into the market and making the customers know about your product, that is the activity of promotion. That is what you need to understand. And what are 4 major direct promotional methods or tools? The first one is the personal selling. It is the oldest form of promotion. See, before the advent of mass media like newspapers or TV, radio, advertising and all, just companies used to appoint some sales personnel and ask these sales personnel to meet the prospective customers, convince them, persuade them and close the sale. That is the conventional way of dealing with the customers once upon a time, personal selling. But even today, personal selling methods are used. That is what I told you. We generally use personal methods for premium products, for highly valued products. We use this method of personal selling. And in personal selling, there will be a face-to-face interaction of our sales people with the prospective customers. Customers who are willing to purchase our product. So our people will go and meet them, will convince them, will persuade them. Okay. And here there is an element of personal attention, because you will be directly communicating with the customer on one-to-one basis. You will have an oral communication with the prospective customer, so that our salesperson can talk to the customer, can understand the problem of the customer and can provide a customized or a personalized solution to the problems of the customer. So here there will be a greater bonding, there will be a greater association between the customer and the company. That happens because we are interacting with the customer on one-to-one basis in oral communication. And here in the case of personal selling, our main focus will be on developing long-term relationships with the prospective customers or the potential buyers. Potential buyer or prospective customer refers to the same thing. Okay. And we will tell about our people, our sales people will tell about our products and make the customers convinced about our products, and finally we will look forward to close the sale. Close the sale in the sense making the sale. Okay. But the biggest drawback of personal selling is high cost, because you have to appoint lot of sales personnel, and one salesperson can reach up to 5 or 6 customers a day. That means the outreach is very less. Whereas if you make a very big advertisement in a newspaper or in a TV, that will reach many people. But here, in the case of personal selling, the outreach is very less, and you have to appoint more number of salespeople to make your product move into the market. And the more number of salespeople you appoint, the more salaries you have to pay them. Because the biggest drawback is the salespeople can physically attend only one customer at a time. You cannot attend more than one customer at a time. And even your salesperson may address a small group, but for that also there is a limitation. Okay. And this is not a cost-effective way of reaching large number of people. That is, if you want to reach mass, a very big, large amount of people, then personal selling is not the way. Okay. And especially for fast-moving consumer goods like toothpaste, soaps and all, personal selling is not advised. You have to choose the promotional method of advertising. Okay. And now let us study about advertising. See, advertising is non-personal because here there will be no person communicating with the prospective or potential buyer. Okay. We will just make an ad in a newspaper or a TV or a radio or in social media. So it is non-personal. There will be no one-to-one interaction, oral communication with the potential buyer. But it is highly flexible. See, there are certain restrictions in the case of personal buying, personal selling. Because you need to meet the customer at his convenient times, and all the customers may not give you appointment. These all problems will be there. But whereas advertising, we can advertise in a newspaper so that at any given point of time, the prospective buyer can read that ad, can go through that ad. Likewise, if you advertise in a TV, the person can see it at his convenience, and it is more dynamic. Means there is a lot of chance to make the customers know about your product. And there are several media of advertisement. That means you can publish some pamphlets and you can distribute them. You can publish some brochures about your product and you can distribute them to the public. You can make an ad in the newspaper, in a magazine, or you can have some hoardings. You know, in cities you find a lot of hoardings displaying a lot of advertisements, and you can go for display boards, radio, television, internet. These are all the possible ways of advertising. And see, there are a lot of media available to make the advertising, but you have to be very careful in choosing the media. Okay, that means you have to understand about your target audience, to whom you want to reach. For example, if your target audience is youth, then how you will approach them, how we will reach them, how youth spend their time. Do they watch TV more amount of time, or do they do they use social media, or do they have any habit of reading newspaper? Like this, you have to know, and you have to select the right media to reach your target customers. For example, if people are not watching TV, if your target audience are not watching TV, then what is the use of advertising in a TV channel? It is of no use. Okay, so that you need to find out. And again, what is your market coverage? Do you want to cover the local market or a regional market or a national or international market? That you need to find out. Basing on that, which media is more appropriate? Newspaper is more appropriate, or pamphlet is more appropriate, or local channels are more appropriate, or national channels are more appropriate. Basing on that, you have to choose. And advertising is likely to succeed in promoting the sales of an organization, but its effectiveness in respect to the expenditure cannot be directly measured. That means, for example, if you want to give an ad in a TV channel, it will be very expensive. So you have to spend a lot of money. But what will be the turnout? That is again a big question mark. How many people will look at that ad? Because people will have an habit of browsing through different channels, and whenever they find some advertisements in one channel, immediately they change the channel. So how many people will really see your ad, will look at your ad? How many of them will be persuaded? How many will turn up to make a purchase of your product? So this measurement is not very easy. And on the other hand, you have to spend a lot of money. So that you need to keep in mind. And see, whenever a customer is making a decision to purchase a product, several factors will be there. His utility, he will look at, okay, and he will look at the financial status. Several factors will be considered. And promotion and advertising is one of the factors that will influence the customer to purchase the product. For example, if you are doing advertising very good, but the price of your product is very high, or the packaging is not good, or the delivery is not good, then even though you do a lot of advertising, it is mere waste. That is what you need to understand. And the next one is publicity. Again, publicity is also a non-personal form of promotion, where we use mass media or advertisements in a cheaper way. Okay, it is similar to advertising. Publicity is similar to advertising, but No payments are made. Now, sir, without paying anything, how can we get advertisement? How can we advertise our products? Yes, you can do that. You can promote your products in the form of publicity without paying. How? For example, you can you can conduct a press release about your achievement. For example, your company got an award or you have achieved something, so that you can convene a press release function, and you can tell to the people, so that in the next day newspaper and in all the media channels your news will be published. In that way you can do. Okay, and you may print some reports related to your research, or you may put some important stories, the experiences of your customers in newspapers. That means compared to advertising, okay, this one, publicity will be less expensive. I cannot say it is totally zero, but compared to advertising, publicity is less expensive. Okay, so that is what you need to understand. But in the case of publicity, people should have interest in the content that is given by you. If the content is not interesting, then people may not read what you publish. Okay, and the next one is sales promotion. Sales promotion is related to putting offers like discounts, contests, money refunds, offering goods in installments, and setting up some kiosks. You know, kiosks means some separate marketing tents and all we will put, and we will sell the products. That is called kiosk. And even ATM is also a kiosk to withdraw the money. So kiosk is a setup that you make to discharge, to sell your products. So that is called kiosk marketing. Or you can have some exhibitions to attract the people. You can conduct some fairs. So these are all different ways to make people know about your product and promote your product into the market. And this sales promotion, you have to do it periodically. That means we have a lot of festivals like Dasara festival, Diwali, Pongal, Ugadi. Likewise, we will have a lot of festivals. So at that time, we will conduct some special programs like offering special discounts during those festive seasons. So these all things come under sales promotional activities. Now let us move to the next question. But one more thing I wanted to tell you, please pay attention to similar questions. Don't neglect similar questions, because all the similar questions are given in an application oriented way. So you please focus on those similar questions. Now let us focus on another important thing, various marketing strategies or techniques. The first one is social marketing. What do you mean by social marketing? That means if you observe in the world, there are many ways of marketing your product. People are marketed, places are marketed, goods are marketed, services are marketed. So what are the different techniques of marketing different things? Those all techniques are covered in this particular question. The first one is social marketing. That means if you want to promote a very good social idea among the public, you have to do social marketing, like no smoking campaign, or regarding COVID-19, government have done a lot of social marketing to create awareness among the people about COVID-19. And right now about vaccination, a caller tune has been framed. And these all things, the caller tunes, okay, and sometimes municipalities also, they will use some vehicles to educate the people about the waste disposal, these all things. So these all things come under social marketing. Social marketing is mainly done to increase the acceptability of a social idea. No smoking, polio, pulse polio campaign, or COVID-19, or waste disposal. These are all very important social ideas that people need to be educated. People need to learn, and they need to follow it. So for all these things, the governments and the concerned organizations, they conduct a lot of promotional activities. So all of them, they are called as social marketing. And second one is augmented marketing. So what is the actual meaning of the word augment? Augment is increase. If you offer some increased services, if you offer some additional services besides the traditional services, that comes under the technique of augmented marketing. For example, tickets are sold at the cinema theater generally, but if the cinema tickets are also sold, okay, on online platforms like bookmyshow.com, that can be called as augmented marketing. And if a service is there, generally what is the traditional way of getting a service? The customer will walk into our shop and get the service. But right now, if we offer online services, so that we are available online, so that customer can book a slot and we will directly go to his place and we will offer our services. So these all things come under augmented marketing, means offering some additional customer services and benefits in addition to the traditional methods of servicing the customers. That comes under augmented marketing. And the third one is direct marketing. Direct marketing means what? Already we learnt about personal selling. That comes under direct marketing. And today we have Naptol, TV18, these all Shop TV18, these kind of channels are there, where they directly sell the products. There will be no middleman. If you want, you can call them and they will send the products. Okay. And likewise, some companies, they send some marketing emails to you, asking you to make the purchase. Okay. So these all activities. Likewise, catalog selling. This is somewhat old method. Companies used to send catalogs to you. So if you select whatever items you want from that catalog, you can send that catalog back to the company and the company will deliver the goods to you. Even today that happens in the case of some crackers during Diwali season, where companies, these cracker companies, they'll directly send a catalog to you, to the organizations, so that people can select whatever they want and the goods will be sent through courier. So that is called as direct marketing. So in direct marketing, there are different ways: personal selling, catalog selling, email, telecommuting, electronic marketing, okay, TV shopping. These all come under direct marketing. And next one, relationship marketing. Relationship marketing is a technique to maintain long-term relationships with the prospective customers and with the existing customers, offering them additional services. For example, if you own a Porsche car or a Rolls Royce, and in all the international airports we find Porsche lounge or Rolls Royce lounge, so that if you are a Rolls Royce owner, you can walk into that Rolls Royce lounge and you can get all the free services over there. So that is definitely helpful to build long-term relationships with the customers. Customers are satisfied. And these car companies, whenever your car is having a problem at one place, so immediately they'll come to that place and they'll pick your car up, they'll get it repaired and they'll deliver to your place. So why this has been done? This has been done to make long-term relationships with the customers. And next, services marketing. See, today services marketing is on greater rise. Once upon a time, marketing is done only for products. Product-oriented companies only used to do the marketing. But today, banking services, educational services, insurance services, okay, these all services are largely advertised in the mass media. And they use different techniques of advertising to reach the general public. So that is called as services marketing. And next one is person marketing. Person marketing means what? These all celebrities like sports personalities, film stars, politicians, they will try to promote themselves in the market by doing some social activities, by gathering the people attention. They want to promote themselves and they want to promote them as very good people. So that come under person marketing. And the next one is organization marketing. Organization marketing means many people will not know about your organization. For example, I may be using Tata Salt and I just think that Tata is a company which only makes salt. But that is not the case. Tata is having a lot of other businesses. Now, instead of advertising about one particular product, If Tata advertises about all of its business activities in one particular advertisement campaign, that is called as organization marketing. That means that organization campaign is not intended to promote a particular product, but it is intended to promote the entire organization. In that advertisement, all products are displayed. And finally, the name of the company, Tata, will be promoted. So that is called as organization marketing. And both profit and non-profit making entities, they require organization marketing because they want to make people know about their organization, the greatness of their organization. And next one comes place marketing. Place marketing means tourism. And today, many countries, and in our country also, many states, they are depending on tourism. So they want to market their tourist spots and they want to attract the people to the tourist spots so that they'll get a lot of revenue to the state. So that is called as place marketing, like business sites marketing, tourism marketing. Business sites marketing means if you observe in the newspapers, frequently in newspapers, various states will advertise, asking the investors to come to their state because in their state they are having a lot of infrastructural facilities for the development of the businesses. So they are promoting their state. State is a place. So they are promoting their place. So that comes under place marketing. And next comes enlightened marketing. See, there is a relationship between social marketing and enlightened marketing. Because enlightened marketing means to bring some awareness among the people about a particular product. See, companies, organizations like IRDA, they will advertise telling that never believe the fake insurance advertisements, and IRDA will never, insurance company will never make you a call, or SBI tells, State Bank of India tells, not only State Bank of India, all banks tell that you should never share your OTP, and bank never asks for your OTP. You should never tell your OTP to others. In that way, they create some awareness among the people. So this kind of marketing activity to enlighten the people, to create awareness among the people, that is called as enlightened marketing. And in enlightened marketing, there are 5 principles. First one is customer oriented marketing, that is creating awareness to the customer, and innovative marketing, that is trying to reach the customer to convince him in a better way, and value marketing, that is telling the customer about the value that he gets by purchasing our products, and sense of marketing, that is creating a very good sense among the customers, and societal marketing, which comes under social marketing, already we discussed, and differential marketing. See, for example, if you observe companies like Unilever, they make a lot of products. Unilever makes a lot of soaps. It makes Lux, Hamam, Lifebuoy, okay, Dove and all. But the target audience are entirely different, and they choose different advertising methods and different advertising themes to convince the customers. If you observe, the Rexona ad will be different. It always focuses on moisturizing, whereas Lux always focuses on beauty. Lifebuoy, germ killing, okay, Liril, freshness, Dove, damage repair. That means all these brands belong to Unilever only, but they choose different methods of advertising, different methods of communication to reach the final customers. So that comes under differential marketing. And what do you mean by synchro marketing? Synchro means uniform. See, what about the demand of air conditioners? Generally, the demand for air conditioners will be high during summer season. Okay. Then what about the sales of these air conditioners in the winter season and in the rainy season? Obviously, the sales will be low. Now, these companies will give some discounts, will give some benefits, okay, during those off seasons. Likewise, these all cloth shops, they make a very big Audi sale in the month of Audi. In Telugu, we call Ashada Masam. Because during that season, there will be no festivities, there will be no functions, there will be no occasions, marriages and all. So that's why the sales of clothes will be less. So in order to make the sales uniform, in that off season, they give some special discounts to attract the people. So that can be called as synchro marketing. Synchro means to make things uniform. Okay. And there are several examples for that. For example, in some restaurants during the dull time of the day, they may reduce the prices to attract the customers. That also can happen. And concentrated marketing. Concentrated marketing means if a particular company concentrates on one particular geographical area or geographical market and they want to penetrate into the market deeper and deeper. So that is called as concentrated marketing. Concentrated marketing can be done basing on an area, basing on some people. If you particularly concentrate on that particular activity, that is called as concentrated marketing. And the next one is demarketing. What do you mean by demarketing? See, generally these demarketing practices are done to reduce the demand or deregulate the demand for the products. Okay. Generally, during peak seasons in the entertainment parks, in the theme parks, the ticket prices will be very high. And in some time, at some other times, the prices will be less. Now, why they charge higher price when there is a greater demand? Because to deregulate the demand, to reduce the demand. So that is called as demarketing. That we can see in the Jew parks, or that we can see in the, generally a cinema theater owner wants to pull lot of crowd into the cinema theater. But once the seating capacity is over, he will place a houseful board. Because he don't want to pull more crowd, because already the seating capacity is over. So that means they are following some demarketing practices. That is what you need to understand. Now with that, we have finished marketing strategies. Now let us focus on another functional area which is very important, that is financial management strategies. Now what do you mean by financial strategy of an organization? Already we know financial management is the most important concept of business, because how better you manage your finances, how better you manage your working capital, how better you manage your debt equity ratio, this all will decide or determine the success of your organization. Because you have to give lot of value to the shareholders, you have to create wealth to the shareholders, you have to make your company to run in a profitable way. So in order to do all these things, an organization should have right kind of financial strategy. And generally any financial strategy of the organization will have two important concepts. The first one is the procurement of funds. So organizations should have right kind of strategies for the procurement of funds. How you get funds for your organization? Of course, you can get funds either through debt route or equity route. So what route you choose? How much of percentage you get from the debt route? How much of funds you get from the equity route? So for that, the finance manager should make a right kind of strategy. That is procurement of funds. But the matter will not end over there. After the funds are procured, another important thing is how you apply those funds, how you utilize those funds. You have to utilize the funds in such a way that your investments should give you good returns. That means there should be good return on investment. And you have to create wealth to your shareholders, and you have to pay interest to your creditors. These all things are very important. So the second important area in financial management is application of funds. Application of funds. This is the most important thing. So financial strategy mainly revolves around two important things: procurement of funds and application of funds. And of course, there are many other things that are included in the financial strategy of the organization, like making budgets for your organization, and making projected financial statements and evaluating the net worth of the business. These are also the important areas that are to be covered in the financial strategy of the organization. Okay, so in this concept of financial strategies, we are going to learn about all those things. That means what are the different sources of funds and how the funds are to be utilized and how to evaluate the net worth of a business. These all concepts we will study in this particular thing called financial management strategies. And let us start with the 8th question. What do you mean by financial strategy of an organization? The financial strategies of an organization are related to several finance or accounting concepts considered to be central to strategy implementation. Yes. See, for strategy implementation, we require a lot of funds. See, strategy formulation is very easy. But to implement that strategy, we require men, money, materials, methods, machines, and finally money. How can we get the men? How can we get men? How can we get machines? How can we get the technology? For everything, money is required. So, financial strategies are very important. If an organization is not having right kind of financial strategies in place, it cannot implement the strategies. It cannot do whatever it wanted to do. Because lack of resources is the biggest challenge, is the biggest problem. Lack of financial resources. See, many upcoming companies, many startups, even though they have very creative ideas, even though they can formulate creative strategies for the prosperity of the organization, they cannot execute those strategies. The reason is lack of availability of funds. So, funds availability for the implementation of strategy is of prime importance, is very important, that we need to understand. So, generally in financial management strategy, what are the major areas that I have already told you? Again, in second point here, they are given. What are the most important points? We need to acquire the needed capital, or we need to look at the sources of funds. That is the most important component of financial strategy. Where from we can get the funds, that we need to understand. And second one, developing projected financial statements or budgets. That means how are we going to spend the money? You need to have a plan for that. And how you utilize your funds, how you apply your funds, how you invest your funds. Okay. And evaluating the worth of a business. So these are the major areas. Okay. Major areas of financial strategy of an organization. Now, sir, why evaluating the worth of a business is an important part in financial strategy making means? See, there may be a lot of mergers, acquisitions, forming joint ventures, or whenever you want to diversify your business, or whenever you want to retrench your business. At all these times, it is very much essential to know the net worth of the company. What is your net worth before diversification? What is the net worth of your company after diversification? What is the net worth of the company before retrenchment? And what about the net worth after retrenchment? And whenever you want to purchase a company, whenever you want to acquire a company, you need to know its net worth, its market capitalization. So, evaluating the net worth of a business, the actual worth of a business is very important at times of acquisition, mergers, or diversification, or retrenchment. In all these situations, diversification, retrenchment, merger, acquisition, in all these situations, knowing about the actual worth of the business is very important. Okay. And see, why we require financial and accounting policies for our organization? That is, we want to raise capital in our organization. And you can raise capital through short-term debt or long-term debt. You can issue some shares, equity. So these are all the probable ways. Now you have to think, how much of debt should be there for our organization, how much of equity should be there for our organization, what should be the debt equity ratio, that we need to find out. And we have to decide whether to buy or lease the fixed assets. If you have lot of investable funds, if you have lot of positive cash flows, then you can go for buying the assets. On the other hand, you can lease the assets, you can take them on lease if you find that you don't have the required investable funds. And also to determine an appropriate dividend payout ratio. How much dividend has to be paid to the shareholders? How much have to be plowed back? What is the requirement of funds in the future? So these all things the finance manager have to think, have to make strategies for all these things. And to extend the time of accounts receivables. Okay, that means whether to collect the money from the people in the shortest possible time, or can we delay. These all things the finance manager have to decide depending on the financial position of the organization. And to establish certain percentage discount on accounts within a specified period of time. How much discount we need to give to the people. So that also the finance manager have to decide. And how much of cash on hand should be there. So these are all very important things which decides the liquidity of your organization and make a smooth running for your organization. So a finance manager have to pay attention to all these areas and to all these points. Now, the next question. What are the major components of financial strategy? Okay, already we have studied that. We already know that the major components of financial strategy of an organization are the strategy regarding the sources of funds. Strategy regarding the sources of funds. Now, what are the sources of funds? Debt and equity are the sources of funds. And now, the finance manager should sit and analyze what should be the rate of debt and what should be the rate of equity. That means he has to decide about an appropriate mix of debt and equity in the firm's capital structure. Because if you have too much of debt, that is wrong. And if you issue too much of equity, that is also wrong. So always you need to balance between the debt and equity, and you have to find out the exact mix of debt and equity for your capital structure. And second important component is projected financial statements or budgets. See, you have to analyze your budgets. Intensive screening of your budgets is very important, because if you don't analyze the budgets or if you don't make budgeted spending, lot of financial resources will be wasted. And if funds are not available, you cannot implement your strategies. That is the reason the finance manager of the organization, he has to make a thorough analysis of the budgets. Okay, how much has to be spent, what we are expecting. See, how much we spend depends on what we are expecting. If you are expecting large returns, you have to spend more. So what is our expectation? How much we want to get in return? For that, how much we need to spend? See, without spending, without investing, you cannot get returns. So how much returns you are expecting? And for that returns, how much you need to spend? What should be the budget? This all the finance manager should analyze. And the next one is strategizing utilization or management of funds. Because we can observe that many organizations, they are very inefficient in the application of funds. They make unnecessary investments. They purchase lot of assets. Okay. Of course you can purchase lot of assets for your organization. That is good. But if your decision of purchasing lot of assets at a time, if it reduces your working capital capability, then the organization will not have a smooth functioning, isn't it? So, working capital is very important. So, the finance manager should intelligently decide about the capital investments the fixed asset acquisition, about the current assets, loans and advances. Regarding all these areas, the finance manager should make strategies. Otherwise, there will be a cash crunch in your organization. There will be a problem with the working capital, and your organization will not function in a proper way. And whenever you don't make right kind of choices, and whenever you don't make right kind of strategies for the application of your funds, you cannot implement the strategies in a better way, because strategies requires lot of investments, lot of money. Okay, that you need to understand. And already we discussed evaluating the worth of a business. That is also a part of the financial management strategy. Next. Yeah, this is very important question. Successful implementation of any project needs additional funds. Now, what are the different sources of raising funds and their impact on financial strategy which you as a financial manager consider? Already we discussed this. There are two major routes of acquiring the funds. What are they? The two major routes are, the first one is the debt route, by borrowing the money from lenders, and the second one is issuing shares to the public, that is equity. And each route, that is either the debt route or the equity route, has its own drawbacks, has its own advantages and disadvantages. So, a finance manager of an organization should be in a position to understand all these things, and he has to make right kind of decisions. Okay. Now, successful strategy implementation often requires additional capital. Yes, definitely. If you want to implement your strategy, if you have a very big strategy of gaining lot of things in future, definitely you require a lot of investments. For that you require a lot of capital. And generally, what are the ways of getting the capital? We can get the capital from the internal sources. Now, what are the internal sources? Internal sources are, the first one is the net profit that you get, and the second one is the sale of assets. So, net profit and sale of assets are two basic sources of capital for an organization. Okay. And being a financial manager, it is important to determine an appropriate mix of debt and equity. Debt and equity has to be properly managed. Okay. And major factors regarding which strategies have to be made by financial managers are the capital structure. The finance manager have to decide the appropriate capital structure, and he has to decide about the procurement of capital and working capital borrowings, from where we get the money for working capital, that the finance manager have to decide. And reserves and surpluses. Yes, we will have lot of reserves, reserve for bad debts and all we will have, and we will have some net profit. So what to do with that? How to invest that? The financial manager should look forward. And the finance manager has to maintain good relationships with the lenders, bankers, okay, and other financial institutions. Only then you can get a smooth flow of funds for your organization. And generally, we know that irrespective of the profits that an organization gets, it has to meet the fixed debt obligations. It has to pay the interest. See, you cannot tell to the people that this year we did not get profits, so we will not pay the interest. So that will not work. So irrespective of your profits, whether you are getting profits or losses, whether you are getting more profits or less profits, you have to meet the fixed debt obligations, isn't it? And by thinking like this, we have to meet the fixed debt obligations irrespective of profit. So that will drastically reduce our profits. So let us go for equity. You should not get this idea, because equity, issuing shares to the public, is having its own drawbacks, its own problems. So that should not be the idea of the finance manager, because that seems to be easy actually. Rather than paying interest for the debts and all, if you just issue more shares, if you go for more equity, then there is no fixed obligation that definitely you have to give dividend to the shareholders and definitely you have to pay to the shareholders. That obligation is not there. But should a finance manager do in that way? Should a finance manager think in that way? No, definitely he should not think in that way. He should not do in that way. Okay, so a finance manager should never think that equity is always better than debt for raising the capital. Because I'm telling you the same thing. Each and everything, equity has its own share of pros and cons. Likewise, debt is having its own pros and cons. Okay. See, for example, if you issue more equity to the general public, if you issue more shares to the general public, what happens? What happens? The ownership and control of the enterprise are diluted. Yes. Yes. The promoter's share will be diluted. The owner's share will be diluted because you have to issue shares to the public now. So your control over the organization will be diluted. Okay. And whenever you issue more shares to the public in the form of equity, and whenever the owner's grip on the company has come down, then many outsiders, your competitors, may purchase your shares and they may come for hostile takeovers. Okay, hostile takeovers means unfriendly takeovers. This is a common phenomena that we see in the corporate circles. That this is a common phenomena we can see in the real-time businesses, where a company purchases all the shares of another company and wants to take over that company because they are the biggest shareholder. So that type of problems will be there. So that is the reason issuing more equity is not at all advised. And strategies related to the sources of funds are important since they determine how the financial sources will be made available to the implementation of strategies. That already we know. We know that for strategy implementation we require a lot of funds. And there are different ways to get those funds. One company may rely on external borrowings and another may follow a policy of internal financing. See, that all depends on the situation. If you have very good internal sources of income, or if you have a lot of investable funds and resources and reserves, you can go for internal financing. On the other hand, you can go for external borrowing also for getting the funds for strategy implementation. That is the essence of that particular question. Now the next one, how the worth of a business is evaluated. How the worth of a business is evaluated. That means already we discussed. Evaluating the net worth of a business is very important because whenever you are acquiring a particular company, you want to know the actual worth of that company. How much price we need to pay to acquire it. Or whenever you are merging with another company. So you need to know the actual worth of these two merging companies. That is very important. Okay. And what is the individual actual worth, net worth, and what is the combined net worth of, that means before merger what is the net worth of the two companies, and after the merger what is the net worth of the merged entity, that we need to find out. And also we need to know the net worth of the company to create a positive image among the public. Okay. And if our company is having a good actual worth, that is a great news to our shareholders, and many people are attracted towards our company to invest their money into the shares of our organization. So we have different methods. The first one is the net worth or stockholders equity. That is one method. So in this method what we do is we will minus the total liabilities from the total assets. Okay. So this is the simple calculation to get the net worth of a company. That means you can arrive at the net worth of a company by subtracting the total liabilities from the total assets. And the second one is future benefits to owners through net profits. So here we will use some 5-year average profit level to find out the net worth of the company. And the third one is market determined business worth. In this market determined business worth, this is one method. In this again we can have 3 different sub methods. We can have a comparative price method which may not be very accurate. Comparative price method means what is the selling price of another company, we will find it out. And we are also a similar company like that. So that company's worth is some X. Then automatically our worth also will be the same. In that way we will find out. And the second one is price earnings ratio method. Price earnings ratio method means the market price of the equity shares is divided by the annual EPS, annual earnings per share, and multiplied by the firm's average net income for the preceding 5 years. So in that way you can get the net worth of a company. And there is another method called outstanding shares method. In this method what we do is we simply multiply the number of shares, okay, in the market by the market price of the share, and we will add some premium. So this is another method. So these are the 5 methods of evaluating the net worth of a business. What are they? Net worth or stockholders' equity, future benefits to owners through net profits, market determined business worth, and in that again there are 3 sub methods: comparative price method, price earnings ratio method, and outstanding shares method. So we will learn about these things in detail line by line in the next session. Thank you.